Graham's error. Charlie Munger. Ben Graham had a lot to learn as an investor. His ideas of how to value companies were all shaped by how the Great Crash and the Depression almost destroyed him. It left him with an aftermath of fear for the rest of his life, and all his methods were designed to keep that at bay. The crash of October 29, 1929, was hard on Graham, and the ensuing crash in 1932 was devastating. After the crash of 1929, stock prices started to rise, increasing by 30% by 1931. The crash of 1932 was completely unexpected and the worst in the 20th century. It drove stock prices down by 89%. If you had $1,000 invested in the Dow on September 3, 1929, it would have gone down to $109 by July 8, 1932. To protect himself in the future, Graham developed the concept of the margin of safety, a quantitative approach to valuation that he adapted out of bond analysis and the fear of bankruptcy. He looked for companies that were selling on a per-share basis for less than their book value. Thus, he developed the buying the whole business approach. He'd value the whole business at, say, $10 million, and then he would gear out what the company was selling for on the stock market. If it had 1 million shares outstanding and was selling at $6 a share, he could see that the stock market was valuing the entire company at $6 million. But its intrinsic value was $10 million, which gave him a margin of safety of $4 million. So even if the stock market crashed, the company's $10 million intrinsic value would eventually pull its stock price back up. Where this hurt him was that his system required him to sell an investment once it reached its intrinsic value. There was no such thing as holding a stock for 30 or 40 years, as Charlie and Warren do. If he had bought Berkshire Hathaway in 1974, when it was selling at half its book value, he would have sold it in 1980, when it was selling above book value. There would have been no riding it to $210,000 a share in 2016. His investment philosophy was designed to make him money and to protect him from losses. But it also stopped him from ever benefiting from the compounding effect that a great business can generate over a period of 10, 20, or more years.